What if one bank's collapse triggered the worst economic disaster since the Great Depression? What if it nearly brought down the entire global financial system? This is the story of how the fall of Lehman Brothers in 2008 didn't just ruin Wall Street, it shook the very foundation of capitalism. Stay with us until the end to find out why the world's response changed the way money moves forever. But before we dive in, let me know if you're enjoying this kind of history. Tap that like button and subscribe, only if you truly love what I'm doing here. Part 1. The fuse was already lit. In the early 2000s, it felt like nothing could go wrong. The economy was buzzing. Stocks were climbing, unemployment was low. Interest rates were even lower. For ordinary people, it was the perfect time to chase the American dream, owning a home. For Wall Street, it was a playground. The housing market became the golden goose, and everyone was crowding around it. Homes weren't just places to live. They were investments. ATMs you could live inside. Prices soared. The more they climbed, the more people bought in. And the more people bought in, the higher prices went. Felt unstoppable. But underneath the glossy numbers and cheerful headlines, something dangerous was building. Few understood how fragile it all really was. Fewer still cared. All they saw, but the thirst for profits wasn't just in the suburbs. It was in boardrooms, trading floors, and executive suites. Banks and investors became obsessed with housing. The logic was simple. People always need homes. Homes rarely lose value, so why not lend to everyone? And that's exactly what they did. Lenders threw out the rulebook. Credit scores, income verification, no problem. You want a mortgage? Here's 3. Buy a second house. Flip a third. The risk didn't matter. After all, the lenders weren't the ones holding the loans for long. They were packaging them up, bundling thousands of these mortgages into shiny new financial products. Wall Street had found its latest drug, and it was addictive. Mortgage-backed securities spread like wildfire. Everyone wanted a piece. From massive investment firms to tiny regional banks, it felt like free money. And it came with a promise: as long as people paid their mortgages, the system would hum along. But buried in those shiny products were thousands of toxic loans. Risky borrowers. No income, no jobs, no assets. They called them subprime. And they were everywhere. These bad loans were wrapped in layers of complexity, like financial Russian dolls. You couldn't see the danger unless you cracked them open. And no one wanted to. Instead, they built more. Layered them into CDOs, collateralized debt obligations, which pooled the mortgage-backed securities into even bigger packages. These were stamped with high ratings, passed from bank to bank, and sold across the world. A single mortgage in Florida might end up affecting a pension fund in Sweden. The risk was invisible, but it was there, and it was growing. This was no longer just about housing. It had become a global experiment in greed, leverage, and blind trust. An intricate tower of bets stacked on top of bets. At the center of it all stood Lehman Brothers, a legendary investment bank, over 150 years old. It had weathered wars, crashes, and depressions. But now it wanted more. Lehman dove headfirst into the mortgage market. Not cautiously, aggressively. They bought up risky lenders. They loaded their books with mortgage-backed assets. They took on enormous debt to fund even bigger bets. At times, they were leveraged more than 30 to 1. For every dollar they had, they borrowed 30. all to squeeze a bit more profit from a housing boom they thought would never end. Inside Lehman, executives celebrated record earnings. Traders cashed million-dollar bonuses. The firm's name was a symbol of strength. But behind the curtain, they were building a house of cards. And every card was a loan that someone might not pay back. One breeze, one downturn, and the whole thing could topple. Then came the cracks. First, a slowdown. Housing prices stopped climbing. Then they dipped. Suddenly, homeowners couldn't refinance. Adjustable rate mortgages exploded in cost. Defaults crept up. Foreclosures rose. The same loans that once looked like gold began to rot. Mortgage-backed securities lost value. Investors started to worry. Some pulled out, but many clung on, trusting the market to bounce back. Didn't. The machine was breaking, and Lehman, stacked with bad assets and massive debt, was dangerously exposed. But denial was still the mood on Wall Street. They were too deep in, too committed, too blind, until it was too late. The first domino was about to fall, and Lehman, drunk on risk, was standing right in its path. Part 2. The collapse heard around the world. By mid-2008, Lehman Brothers was in free fall. Its vast portfolio of mortgage-backed assets had turned poisonous. No one wanted them. Investors began dumping Lehman stock, and its value nosedived. Billions vanished from its market cap in a matter of weeks. Confidence was gone. Credit rating agencies downgraded the firm. Hedge funds pulled their money. Counterparties refused to trade. It was a modern bank run, unfolding silently through computer screens. Inside the firm, panic set in. Executives scrambled to find cash, to find buyers, to find anyone who still believed they were solvent. But belief had vanished. Their assets couldn't be sold. Their liabilities were towering. The walls were closing in. Every second felt like an hour. Every failed deal brought them closer to the abyss. And all the while, the rest of Wall Street was watching, calculating, and quietly preparing for what looked like the end of a giant. Then came the infamous weekend, September 13th and 14th, a race against time. U.S. Treasury officials, Federal Reserve leaders, and Wall Street executives crammed into boardrooms in Lower Manhattan. The goal? Stop Lehman from collapsing. Several potential buyers were on the table. Barclays, Bank of America. But Lehman's books were a mess. Toxic assets were everywhere. No one wanted to touch them without guarantees. Talks stretched through the night. Coffee ran out, tempers rose. There were moments when a deal seemed close. But one by one, the lifelines snapped. Bank of America bailed. Barclays backed away. The U.S. government was asked to provide a financial safety net. But they hesitated. Just months earlier, they had bailed out Bear Stearns. They didn't want to set a precedent. Letting Lehman fall, some thought, would teach Wall Street a lesson. On Sunday night, the talks ended. No deal, no buyer, no rescue. On the morning of Monday, September 15th, Lehman Brothers filed for bankruptcy. It was the largest in U.S. history. Over $600 billion in assets wiped off the map. Offices were emptied. Bankers left carrying boxes. Years of legacy shattered in one night. The impact was immediate. Global stock markets crashed. Financial institutions panicked. They didn't know who had exposure to Lehman's toxic debt. They didn't know which firms might fall next. Trust vanished. Banks refused to lend not just to customers but to each other. Credit, the lifeblood of the economy, froze. Corporate borrowing halted. Business investment dried up. Mortgage lending stopped. Even profitable companies couldn't meet payroll because their short-term funding had evaporated. The financial world had slipped into a coma, and no one had a plan to wake it up. The shockwaves traveled fast. Overseas markets tumbled. Central banks were caught off guard. Pension funds and insurance companies found themselves holding worthless Lehman securities. In Asia, trading floors went silent as prices plunged. In Europe, governments scrambled to reassure panicked citizens. In the United States, the fear became visceral. ATM lines grew longer. Families began withdrawing savings. Small businesses lost credit lines overnight. Millions sensed that something enormous had cracked. It wasn't just about Wall Street anymore. It was about Main Street. The collapse of Lehman had become a psychological event. It told the world that even the biggest could fail. And if Lehman could fall, who was next? No one felt safe. And when no one feels safe, money stops moving. That was the true terror. Not just the fall of one firm, but the collapse of belief in the system itself. Lehman Brothers was gone, a ghost on the skyline of global finance. But its absence left a crater, and into that crater poured fear, suspicion, and chaos. The financial system had been built on trust, invisible, unspoken, but essential. Now that trust had cracked, and behind the scenes other giants were wobbling. AIG, the insurance titan, was buckling under its own toxic assets. Merrill Lynch, once a titan of wealth, was rushing into the arms of Bank of America. Wachovia and Washington Mutual stood on the edge. Central banks were flooding the system with emergency funds, but it wasn't enough. This wasn't just a banking crisis anymore. It was an existential crisis for global capitalism. The machine was breaking down, and if the right domino fell next, the entire system might collapse. Lehman was gone, but the real danger was only beginning. What if the next bank failed? Or the next country? Part 3. Saving Capitalism at Gunpoint. After Lehman collapsed, it was as if the financial system began to disintegrate in real time. Within days, AIG, the massive insurance firm that had quietly guaranteed billions in mortgage-backed deals, was teetering on the edge of its own collapse. It had sold insurance on the very assets now turning worthless. If AIG failed, the chain reaction would be unstoppable. Merrill Lynch, sensing its own death sentence, raced into a shotgun merger with Bank of America. Wachovia was bleeding fast. Washington Mutual, once the largest savings and loan bank in America, became the biggest bank failure in U.S. history. Confidence was dead. The dominoes were falling faster than anyone could catch them. Governments and central banks realized this wasn't just a market crash. It was a systemic unraveling. One wrong move could bring down the entire global economy. The idea that capitalism could survive without intervention was rapidly being erased. Now, survival meant taking drastic, unthinkable action before everything disappeared. With fear turning to paralysis, the U.S. government stepped in with something radical. A lifeline called TARP, the Troubled Asset Relief Program, a $700 billion emergency fund to buy toxic assets and inject capital into failing banks. Congress resisted. Protests exploded. But the alternative was collapse. The bill passed, The Treasury flooded banks with billions. At the same time, the Federal Reserve slashed interest rates near zero and pumped trillions into the financial system through emergency lending. Central banks around the world followed. It wasn't just about saving banks. It was about saving everything connected to them: credit cards, car loans, small businesses, payrolls, retirement accounts. It was capitalism on life support. The rules were being rewritten overnight. The invisible hand of the market had let go. Now, governments were the only thing keeping the system upright. But even as the money flowed, confidence didn't return immediately. People were scared and angry. The rescue felt like a reward for those who had broken the system in the first place. While financial institutions were being propped up, everyday people were falling apart. Jobs vanished by the millions. Families lost their homes. Entire neighborhoods went dark. Retirement funds were wiped out. Iceland's banking system collapsed under foreign debt. Greece entered a debt spiral that would rock the Eurozone for years. Riots broke out. Angry citizens stormed parliaments. In the United States, the Occupy movement took to the streets. In Europe, trust in governments dissolved. It wasn't just a financial crisis. It became a social and political one. People questioned everything: banks, capitalism, globalization, even democracy. They saw billions going to Wall Street while they faced foreclosures and unemployment. The rage was real, the damage personal. For many, recovery would take years. For others, it would never come. The financial system may have avoided total collapse, but it had broken something deeper: belief in fairness. And once that belief was gone, it wouldn't come back easily. As months passed, the panic began to ease. Credit markets thawed, some banks stabilized. Stock markets began to crawl upward. Slowly, the bleeding stopped, but the scars remained. Governments tightened rules. Capital requirements were raised. Risky practices were reined in, at least on paper. A new regulatory framework emerged. Dodd-Frank in the United States. Basel III internationally. Stress tests became the norm. Too big to fail was no longer a theory, it was official policy. Banks were merged, nationalized, or restructured. The financial world had survived, but it had changed. There was no celebration, just exhaustion. People were still recovering emotionally and financially. The markets were open again, but trust in banks, in systems, in leaders was shattered. What had once been a smooth, unquestioned flow of capital was now cautious, heavily monitored, and forever altered. The crisis had forced the system to look in the mirror, and what it saw was a monster barely held together by tape and hope. Capitalism didn't fall, but it limped away from the edge, bruised and redefined. The collapse of Lehman Brothers was more than a bankruptcy. It was a rupture in the global order. It forced the world to admit how interconnected and how fragile the system had become. One bank's fall exposed decades of unchecked greed, weak regulation, and blind faith in markets. It exposed how a house in Florida could sink a bank in New York, which could then spark protests in Athens. The system survived, but only because the rules were bent, the playbook rewritten, and the price paid by millions. Lehman was allowed to die, but in doing so, it revealed a truth the world couldn't ignore. Capitalism, without a safety net, without boundaries, without reform, can consume itself. In the end, it wasn't just about saving money. It was about saving the idea that the system could work at all.